Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me for this segment, we have Dave Albrycht, President and Chief Investment Officer at Newfleet Asset Management, to discuss the pitfalls and opportunities in the fixed income market. Dave, it's great to see you as always. Welcome back to Trade Talks.
Thanks, Jill. Thanks for having me.
Let's talk about the risks and uncertainties in the domestic and global markets. What's top of mind for you?
I would say domestically, without question, is the timing and the magnitude of the slowdown. I think we know it's coming. I think we feel pretty confident that the Fed can thread the needle and orchestrate a soft landing and mild recession for a few reasons. First, if I look at the consumer, unemployment is very low. Wage gains have been very, very dramatic. They're coming from a point of strength. 6 months ago, delinquencies on credit cards, autos, and mortgage loans were at a 40-year low. So the consumer's in good shape. If I look at corporate balance sheets, they're very strong. Leverage is down, interest coverage is up. And most high yield companies have termed out their debt. So that bodes well. And then lastly, if I throw on top of that liquidity, not only in the public markets, but now there's about 1.5 trillion of private credit available. So I think that, that definitely on the domestic front. Globally, I have to look at Russia. Things aren't really getting better there. We know they tried to weaponize energy, but, Europe luckily had a warm winter. Right now the grain extension pact has not been met. That's a little disheartening because 30% of the world's wheat comes from Russia, Ukraine, and we well know a lot of that goes to the emerging economy. So we'll watch that very closely, and nobody wants a rogue Russia. Can't forget China. The COVID lockdowns were a thing of the past. However, growth now at 3%. PMI is below 50. Twice in the last week, they've cut rates and tried to stimulate. Now, we know they have a problem with the real estate sector, and they have a problem with their shadow banking, and we'll watch that very, very closely also. Can't forget the pandemic. Virus, a new vector, new variant. What is policymakers' response, and what do the public do? We'll have to watch that closely. And last but not least, with a slowdown in the economy and earnings beginning to slow, you have to think about defaults. If I look at the high yield market, we're coming from a very strong point. High yield defaults by issuer 1.53%. The average, the long-term average is about 4.1, so dramatically lower. And then even in bank loans, we're at 1.75, and the long-term average is 2.9. So starting from a very good point, and I think based on those factors that the Fed will be able to orchestrate a soft landing.
Well, let's talk about that some more. What about your current view on inflation and interest rates, and of course the yield curve as well? We know the Fed is hyper-focused on that core number of 2%, and they're still a bit of a way off from there.
Right. Well, if you look at inflation, if you look at headline inflation, it's down from 9% to 3%, trending in the right direction. You're exactly right that core is much higher, and core PCE are both in the 4s. They want to get to 2%. Right now, they've, as we well know what they've done, they did their 11th rate increase, 525 basis points, then they paused. Looks like right now 50-50 for another rate increase by year end. That's going to be highly dependent on the data. We had Jackson Hole. If they pause in September, they'll have a lot more data to look at, and that's going to be very telling. If I look at the yield curve, just like you mentioned, it's been inverted for about 14 months. Usually 12 to 18 months after the inversion signals a recession. However, it's not the cause of a recession. So we'll watch the yield curve very, very closely. It's definitely worth noting. And then last but not least, if you look at what's happened to the curve, extreme move in rates. The 2-year Treasury is now 5%. The 10-year is about 4.20. The 30-year is about 4.35. Rates have been extremely volatile. All that being said, I think there's now value across the entire yield curve.
So how are you thinking about approaching the fixed income markets? Where are the pitfalls and where are the fixed income sector opportunities?
Absolutely. Well, I sort of like to characterize it by value's been restored to the fixed income market. If you went back to the end of 2021, 2022, yields were dramatically lower. Structured product were yielding about 2%. IG assets were yielding about 2%. High yield and bank loans were yielding 4%. Flash forward to today, IG is giving you 5.70. Bank loans are giving you over 10%. High yield is in the mid 8s, and even emerging markets is 7.5%. So, those are very good entry points, especially when you look at dramatic discount dollar prices, right? Everything was at a premium before. Now, if a guy like me does a good job and bonds typically mature at par, you not only get the total return, but you also get that nice income. If I look at certain sectors, I'd say leverage finance. We like both high yield and bank loans. Right now, you can get a double B bank loan. I love up in quality. The current coupon is 8.5%. from a good quality company that doesn't need to refinance with solid fundamentals. In the high yield market, you can get 7 to 8%, double B, high quality. And if there's any, if there's any weakness, then you can start taking a look at some of the lower rated credits, but you really don't need to go there. On IG, we like to add duration, especially like the financials. GSIB banks make sense, a JP Morgan, a Chase, a Citi, even some of the regionals like Huntington Bank, they're good opportunities, well diversified, good deposit base. We like that. And then without question, some of the securitized product asset backs giving you a 7.25 yield on a 2-year duration with a single A credit quality, even non-agencies, double A credit quality, mid-6s, very attractive yield, short, looks very attractive. And one we're sort of avoiding, we've been avoiding for the last 5 years because of the weakness in retail was commercial real estate. But right now I can get a AAA 5-year at a 7% yield. So starting to look at some of the new conduit paper, there we do like the industrial warehouses, some of the data centers, single asset, single borrower deals.
And you continue to be at or near all-time lows in international exposure in your multi-sector portfolios. Are you beginning to see any opportunity there?
Yeah, the international portfolios, coming into the pandemic, we looked at it and said valuations were just pretty full. Very recently, we've been very tactical with some of the dollar-denominated sovereign, Mexico, Hungary, Serbia, to mention a few. And then when the Fed was raising rates and the dollar was strong, last thing you want to do is own local currency. But right now, since we're sort of at the end of that tightening cycle, we're starting to take a hard look at Mexico, Brazil, Colombia, all make sense. Like I said, it's a country by country basis. You have to determine whether you want to be in the sovereign, a corporate, and you want to take that currency exposure, have dollar denominated risk. So good way to diversify. Yields are very compelling. I mean, high yield EM is yielding well over 11%. The EM market in general is about 7.5 and IG is about 5.60. So definitely there's opportunity there.
And finally, thoughts on the muni market?
Well, the muni market, 125 billion of outflows last year, 8 billion of outflows this year. A lot of that was tax motivated selling. People were locking in losses, trying to offset, any of the gains that they may have had. If I look at taxable equivalent yields right now, IG is paying you 640. You're getting 990 in high yield. Those are type yields that we haven't seen going back to the global financial crisis. Defaults here really don't occur. I think we had somebody said, maybe it was about it was longer than that, maybe it was 10 years ago, about there'd be $100 billion of defaults in the muni market and only 90 million materialized because of one reason. An essential service revenue bond and a GO can always raise your taxes. So one thing they forgot is look at the fundamentals. They're actually good. Property revenues are up. 540 billion of stimulus money came during the pandemic. And we think it's a great entry point for an individual. As a crossover guy, probably not that compelling with ratios in the 60% range. To get back to 80% of the 10-year treasury, or the 30-year gets back to 90%, we'll start looking at munis again as a crossover buyer.
All right, Dave, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thanks, Jill.